Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Today, we're talking about the Battle of the Titans. We're talking about two funds that have become household names and that have accumulated assets under management that others turn green with envy looking at. We're talking about Parag Parikh Flexi Cap Fund, which has assets under management of over 1 lakh crore rupees, and HDFC Flexi Cap Fund, which is a much older scheme, if I'm not mistaken, and has a pretty sizable AUM to boast of as well. But which one should you invest in? Or should you avoid both and go for a much smaller name? Let's talk about that with Kshitij Mahajan, who is the Managing Partner and Chief Executive Officer of Complete Circle Wealth Solutions. Kshitij, we're going to put this matter to rest today. And you're going to be judge, jury, and executioner. So therefore, let me ask the first question. What do you make of these two schemes?
Well, hi, Alex. I think remarkable journey for both of them. Let's talk about Parag Parikh first. Started in 2013. I think Rajiv Thakkar and team they're fantastic, doing some great stuff. The only fund which initially started exposing some allocation toward international equity as well. In fact, it's more of a value and contrarian investing. That's what this fund follow. And interestingly, what they've done is, as we speak, also they maintain a lot of cash position and some money in arbitrage to have some powder dry to keep on having opportunity that they can deploy. So consistently they believe in one thing. I think they strictly follow what Warren Buffett's style of investing. Rule number one: don't lose capital. Rule number two: follow rule number one. That's what they've been doing in this fund. They are very happy to bet on those stocks which are beaten down in terms of their valuation, trading below intrinsic value, like to wait for long. If you see from the fund style also, normally you see equity funds are 1% exit load. They have 2% for the first year and 1% for the second year. So I think in a way it's a flexi cap approach which has shaped up really well. And they don't have any other active mutual fund, by the way, except for one tax saver fund. They have only this flagship fund, and they don't have any intent to launch any other fund. So I think very beautifully managed portfolio over a period of last 12 years, and very consistent in terms of ruling returns also. So that's on the Parag Parikh fund. On the HDFC fund, it's a Prashant Jain sir pedigree. That's what been followed. And after 2022, Roshi has taken over, who was managing a lot of funds, good funds on the flexi cap side and other funds in fractioning. And the fund, because it's more of GAP, which is growth at reasonable price strategy at what they are doing. It's a mix of value and as well as growth style. But yes, the fund tend to allocate more towards reasonable valuations. At the same time, the fund has seen some time frame of or ruling returns of lesser return because of the high conviction bets which they play and a concentrated bet which they take, which they have done on the PSU side, which actually favored them from 22 to 23 and then 25 rally. So I think it's a very different style. It complements somebody who's having Parag Parikh in their portfolio.
Interesting.
Yeah.
Okay, so it's a complementary style. But let's talk about several metrics that you can compare the two with, and then we'll come out with a clear winner, if at all, right? So first, you've already kind of mentioned this, but I want to delve a little deeper into this. When people talk about Parag Parikh, they of course talk about Rajiv Thakkar. And of course, the team around him as well is equally brilliant. I had them in the studio a while back on MoneyWise, and they said, in all modesty, we have over 1 lakh crore because we've chosen a concentrated strategy where we have one fund. Whereas at the portfolio level, at the AUM, at the mutual fund level, a lot of mutual fund schemes, including HDFC, have over 1 lakh crore across schemes. So that is the point that they made, but that's fine. Leadership, how does it match up? Because in HDFC Flexi Cap, you have the fact that Prashant Jain has left in 2022, has his style maintained with the current manager.
Yes, Alex, if you actually see, they have not done away with most of the portfolio, and that's actually resulted in outperformance of HDFC Flexi Cap in the last 5 years. Had it been they have taken away that portfolio, it would have resulted in underperformance because value strategies actually played out really well in 22, 23, 24. So one is this. Second, Roshi has brought a lot of value-add changes in terms of taking much more concentrated bets on some of the ideas, where like telecom is one piece where she was well into first in this fund, where not most of the funds were buying into. So I think a couple of ideas which she has taken has really played out very well. So I think that's the right way to do it. A fund style, if it's done well over the last 28, 30 years, you continue with the same style and keep on adding your value, how you can better it by 1 or 2% in coming times.
Okay, so let's talk about style as well. And you did mention the two, right? On the one hand, Parag Parikh very clearly a value-oriented style, and they don't shy away from taking cash calls. In fact, I haven't looked at the latest fact sheet, but the last that I looked at, 24,000 crore or thereabouts is cash and cash equivalents, and they had a few REITs as well, which they added very small amount, but as part of their fixed income slash cash management strategy, because the yields are better than what you would have on fixed income fixed income products when the rates are going down, right? So because policy rates have come down, so that's what they said. What is the comparison with HDFC Flexi Cap? How do they use cash?
So Parag Parikh has almost 67-68% in domestic equity. They have 10-11% in international stocks, and as you said, 20-21% is there in cash, in short-term papers, fixed income, as well as liquid fund, as well as arbitrage. Wherein HDFC Bank maintain 6-7% only. HDFC Flexi Cap maintains 6-7% only as a cash position, and they have almost 12% in small cap, 4% in mid cap, and remaining almost 80% around in large cap. It's more of a large capish fund. It's like they are betting on the large cap story of India, and that's what they are maintaining it. But they maintain 6-7% cash as we speak.
So they comparatively smaller, but they're pretty large nonetheless, and so they have a much different approach to deploying funds, and I think that broadly they're only keeping a little bit of powder dry, which again reinforces their growth at a reasonable price kind of a philosophy. But let's talk about some of those portfolio allocations, right? If you talk about Parag Parikh versus your HDFC Flexi Cap, is there a comparison that you can make to the portfolio style?
So yes, I think the top sector allocation is financials only, BFSI only, but as HDFC has almost 40% towards BFSI, wherein Parag Parikh has 26-27% towards BFSI. HDFC has little more, 12-13% towards automobiles, and almost 11%, which is one of the highest in the industry on the pharma side also. Wherein Parag Parikh has towards capital goods, infra, as well as automobiles, and then some allocation toward pharma side, 4-5% also. So you get a complementary sector allocation also. Some names are same, but the bet which they're playing on is very different. Like they both have HDFC, ICICI Bank, Maruti is on that side, on the automobile side of HDFC. So I'm saying many of the top holdings, sometimes you look, there are 3, 4, 5 common names, but at the same time, I must say that the allocation which they are playing is a little different vis-a-vis the other fund. So I think these are the key sectors on which they are maintaining their key weightages.
Interesting. HDFC Bank, for example, you shared this data with me. June 30th, they had 8% or thereabouts Parag Parikh, whereas HDFC Flexi Cap had the top holding as ICICI Bank, 9.3%, and second holding was HDFC Bank, also comparable, 9% or thereabouts. But Parag Parikh only has much lower, which is about 4.8% in ICICI Bank. So as you pointed out, yes, there is commonality in portfolio, but the allocation is very dramatically different. And in the top 3 or 5, HDFC Bank seems to have taken a more concentrated bet on these two counters. So if you say about 18-19% is, and maybe even more than that, so you're talking about 24% or 25% in just 3 banks, is a very, very concentrated bet. Would you agree, Kshitij?
I 100% agree, and as a house, we also feel that these companies, these banks will do very well. Now, it totally depends on fund manager conviction, how much percentage holding they want to give. Now, for that matter, let's say Parag Parikh has almost 6% plus in Power Grid as a company. So I'm saying, and Power Grid has its own journey, how things will play out, but they don't mind waiting for the right time, because they say that, okay, boss, we have taken money, don't come before if you don't have time for at least 5 years with us, and they will like to wait and play that entire story or journey. But they play to their conviction, they have that allocation given to Power Grid. So again, that shows the confidence of a fund manager, how well researched they are. Again, they have no repo, but I think that it's a different style, but yes, it complements each other.
You've said that before. We'll come to that in the conclusion, because I want to talk about one of the USPs of Parag Parikh Flexi Cap Fund, which does not remain a USP, which is that though they have that 11% allocation towards international, it is dropped from close to 30%, which by their own admission, they wanted to keep between 25 and 30% as an ideal portfolio allocation, but because of the restrictions, they can't do that anymore. So they have had to double down on domestic companies. Is that now, would you say, a negative? Would you say that now, more than ever before, they are comparable to an HDFC Flexi Cap?
I will not say that, Alex, because still on a portfolio of 1,10,000 crore, you have 10,000 crore allocated towards international stocks. So I feel that someday the window will open and they will step up the allocation toward these stocks. At the same time, the percentage which they are having in India context is not even in decimals with regard to the global market caps what these stocks are having. So I'm saying that's the right way to play. They have four holdings which they have. They have Meta, they have Microsoft, they have Amazon, they have Alphabet. These are the four core holdings which they are holding right now. So I'm saying I still feel that it's a quasi play of international allocation with the Indian taxation, if you actually ask me. And today we are having 11% allocation. They're having 11% allocation. Tomorrow they might switch, or if the window will open, they might increase that allocation also. So I think the initial, yes, the initial kicker, you're right, has come from your international portfolio, which was doing well also. But yes, they have Indian portfolio also, which is really doing very well for them.
But just to clarify this point, Kshitij, a lot of people used to invest in Parag Parikh Flexi Cap Fund because of the international allocation that it gave you, and there were several advantages, right? No requirement to convert on an ongoing basis. Portfolio churn exists. If they want to add to a position, they can do so. You have that allocation in your portfolio, but now that is not available. So I'm saying that this is not a reason to invest in Parag Parikh Flexi Cap anymore.
Yes, I 100% echo that. But now I think people have started liking the way they are managing the fund overall.
Yeah.
But I 100% echo that yes, right now, the way you used to invest because of that 30% allocation you get in the foreign stock, that is not there. But yes, the overall, I think, style, the way they are managing fund has been liked by most of the clients.
Okay, now the bottom line, Kshitij, is whether or not fund performance has existed. And of course, this is the result of several factors, and we'll talk about some of those factors, among them downside capture, which tells you how the fund has performed when the market has gone down, and upside capture, which tells you how the market is done when the bull market is taking place. But how have the numbers stacked up in terms of performance over the last several years? And Parag Parikh has a history now of 12 years. I think HDFC Flexi Cap is older, right?
Yes, it's much older.
Yeah.
Almost around 30 years now.
Yeah. So yeah, in fact, we have those metrics. Is one of the funds that a lot of people use to say, if you hold for this much time, then this is the kind of amount of money that you can generate over a period of time. Is a favorite for SIP calculations. But how are the numbers stacked up?
So you see, last 5 years, I think, although we always mention that, but that's not the right criteria. But last 5 years, HDFC Flexi has done almost 28-29% compounding. It has a 5% alpha, and wherein Parag Parikh is around 27% compounding, almost 3.5-4% alpha. That's what they have done. At the same time, since inception, it's 18.5% plus return is for Parag Parikh. At the same time, HDFC during Prashant Jain's time is around 20% plus, because initially the return was really nice. But last 2-3 years had actually dragged the returns down around 2019, 20, and 21, where value was not doing that well. But 22 onwards, again, you see value stocks started doing well. All PSU stocks were doing well. So I think in terms of numbers, it's a right example. You rightly quoted. Somebody is looking at compounding machine. These two funds have been a compounding machine. We always say that the right expectation is around 13-14% compounding from your mutual fund portfolio. But these funds have done exceptionally well over a period of last whatever tenor they've been here for. So kudos to both the style of investments.
Now, what has led to that outperformance is the question, because Kshitij, very clearly in certain periods when the market is doing incredibly well, and this has happened over the last couple of years, Kshitij, where Parag Parikh is actually decelerated, consciously so, because they had a significant amount of cash. And then when you saw the broader markets drop by 20% earlier in the year and then recover by 20%, they might have missed the bus, but certainly they didn't lose as much as other people did when the market dropped by 20% because they had so much cash. And so their drawdowns when the market falls is much less than everybody else. That has led to their outperformance. What about HDFC Flexi Cap?
So, just to make it simple, I think beta for Parag Parikh is around 0.58, which is, I think, the least among all the funds across, and it's 0.83 for HDFC. It basically tells you what type of risk you are taking. At the same time, standard deviation is less, around 9%.
Sorry, Kshitij, just to interrupt you, because you mentioned beta, why don't you explain to our viewers what that metric means?
So basically, beta basically tells you that what type of risk you are taking for generating the returns in the portfolio. So beta 1 means you are as per your respective index, that type of risk you are taking to generate the alpha or generate the return in the portfolio. So for look at Parag Parikh, it's taking almost 40% less amount of risk because of the portfolio which they are into to generate that extra alpha, and that is because of international exposure as well because of maintaining cash position in the portfolio. The value is less. Whereas HDFC, which has 7% cash position, has beta which is again much lesser than 1. So I think that's one thing which you need to understand. I'm generating return for you, but what type of risk I'm taking to generate that return? If it's less than the index return, risk, then it means that fund manager is doing a very good job. So the lesser beta is a better number when it looks at. So I say that the valuation, the way they are managing the fund is immaculate in terms of you have not seen these type of numbers. But yes, the cash position actually helped us. You see, Alex, last 1 year return on index also is almost 4-5% now. It's not much. But if you see the returns for both the funds, last 1 year is around 8%, for Parag Parikh is around 10% for HDFC. So I'm saying on the downside also, when you say downside capture, when markets are falling also, the funds have done well. 2020 COVID, when market in broad index has fallen by 37%, Parag Parikh has fallen by 25% only. Because again, they were maintaining some cash position. Moreover, global stocks were not that down the way it is down now. They were having 30% allocation toward global stocks, wherein HDFC was down almost 31-32%. So a lot to do with while markets are correcting, how the fund is doing, how the rolling returns are. There are a lot of metrics which come into play when you look at a fund allocation.
So, the argument that some have made, and this is something that is being debated, Kshitij, I wonder what your opinion is, maybe we can talk about it on another day, is the size of the portfolio, right? And the ability to stay nimble in this situation and truly have a diversified portfolio that has enough allocation towards mid cap and small cap as well. Therefore, the Security and Exchange Board of India asking whether or not a scheme 2 of the same fund can be launched, and a lot of people have opinions about that, whether it will dilute the original fund or not. But the question is this something that an investor should be wary of and to allocate into nimbler schemes? I think we've spoken about this as well, but what is the answer here?
Alex, look, they have 3 to 4% allocation when you talk about Parag Parikh towards small and mid cap. Their approach is, or HDFC Flexi Cap approach is, they are having 80% plus large cap allocation only on the equity side. So they are very clear that they want to play on the large names, robust business with very high growth, or let's say some of them with a low intrinsic value. They want to play on that. So they are very clear how they want to structure the portfolio. So size doesn't matter in these type of fund, because I agree, if you want to keep it can be a problem for a multi-cap fund where at least 25% allocation you have to give to small or mid-cap. But in these markets, they are playing it rightly in terms of the allocations they're doing. HDFC has 12% allocation towards small cap at 80,000 crore fund and 4% toward mid-cap. So yes, going further and maintaining the same amount of allocation towards small and mid-cap becomes difficult, because you can't have that type of bet. And otherwise, you have to take a lot of names in small and mid cap so that you can allocate toward that theme. But yes, I think for the time being, India is growing. There are a lot of large cap companies. We keep on talking about large cap allocation. Our largest company is Reliance Industries, around 200 billion market cap. Apple has more than $300 billion cash reserve in the books. So eventually, India large cap will also become much bigger in terms of its size, and opportunity will keep on coming. But I agree with you. If you want to have more smaller and mid cap allocation, this size right now for India might not be the right approach.
So therefore, the conclusion, Kshitij, you mentioned that they complement each other and both can find, therefore, place in your portfolio. But what should be the primary and what should be the secondary, if at all? Or would you have equal allocation? And would you treat both of these or either one of them as the core of the portfolio and have a satellite allocation to something else? Because ultimately, because of the portfolio allocation, they're primarily large cap.
I think you can choose one of them, one of them, rather than just having both the things in your portfolio. Depending on what you like, you can choose one of them. As you rightly said, Alex, that delta which used to be there because of foreign allocation, that's under scanner in terms of they can't step up the allocation toward that. So you can choose either one of them, because you're right, it's a flexi cap fund with more of a large capish bias. So I think, and more of the name as many names on the large cap side are similar, but little different allocation. Both the funds are good funds, but one can add one of the funds out of these two funds.
Kshitij, thanks so much for taking the time. Absolute pleasure speaking with you as always. And viewers, let us know what you think. These are household favorites, of course, and I'm sure that you have an opinion about holding either one of these or both.